consultancies on investment. Majority of our clients have been pension funds, where we've been doing a lot of capacity building and also consultancy. And we are located here in Nairobi at Embassy House. That is where we are. We also have a small office in Accra, Ghana. So our vision is to be the preferred facilitator of fund services in Africa. And the statement of purpose is a prosperous Africa inspired by dignity. And our mission is to develop and deliver innovative solutions through capacity building, consultancies, and investment advisory services, setting the standard for excellence and accessibility in the retirement industry. And that is where we are. Just want to push something on my screen. I really apologize for that lag. Okay. So our core values are integrity, excellence, client focus, innovation, creativity, and teamwork. And the unique value proposition is that we provide supporting services to funds in order to improve service delivery to beneficiaries and therefore improving the quality of life. Now, perhaps you're talking about what are those funds. We're talking about pension funds, we're talking about unit trust funds, we're talking about private equity funds and many others. So that is the space where we are. And I think I've already talked about our journey. We were set up in 2019, and we've done a lot of work in the pension industry. The training division is started in 2021, where we've been training trustees of pension funds and also their secretariat team in helping them to be better stewards of scheme assets. Now, our services are divided into 3 areas. The first one is training, and we also consider this webinar as part of the training that we do, investment advisory, and also consultancies. So in terms of consultancy, we do a lot of many services, which you can see from your screen. And of course, there are so many, so maybe I can just pick on one. We do a lot of performance analysis and also including independent valuation of unlisted securities. So there are so many, and I believe because this is a retail sector service that we are doing today, maybe I will not touch on most of them. So perhaps I'll concentrate on the training services that we do, including consumer education, like the one we are doing right now. That's what I would call member education, especially if you are going to do pre-retirement training. So we also do human resource training, financial wellness, mental health and well-being support, and also leadership and corporate governance. But most of our training normally depend on the needs of organizations or individuals that require our training services. They are so bespoke or custom-made for the needs of the organizations or individuals that require our services. So we also do so many other things, like strategic plan development, preparation of investment policy statement, and these are for corporate or institutional investors, like pension funds. So those are some of the things that we normally just do. So in terms of training, we have many local trainings, including ones geared for retail market, like the one we are doing now, or institutional clients like pension funds. So we train the trustees. And normally we have open or even in-house training. We also have international trainings, like we have one coming up in July in the Netherlands, and we are doing a lot of benchmarking so that we see what is happening in the developed world and what can we learn from them. We also have local one like the ones that are on your screen. A number of local clients have really trusted our services, trainings, and also consultancies. And you can see we partner with reputable institutions like the one you can see on your screen. So those are some of our clients that we are so proud to have partnered with. I think I want to leave it at that point and then return it back to that we know what we can do from here. Thank you so much for listening.
Thank you so much, sir. Now let's move on to the man of the hour, the speaker of the evening, and he has a long bio, so permit me to read it. So our speaker tonight is financial advisor George Oyuga, who is a polished pension consultant with an illustrious career that spans over 17 years, with experience gained locally and in the region. As a certified professional trainer, he has a passion for stakeholder capacity building with an admirable footprint in the local retirement sector. He is a senior trustee trainer at the TDPK, which is the Industry Trustee Certification Program in Kenya. He is married, for those who might be wondering, with 2 children, and enjoys hiking with an ambition of conquering at least one high mountain annually. He has so far climbed Mount Kenya 3 times, Mount Kilimanjaro once, Table Mountain in Cape Town twice, and Mount Muhavura in Rwanda once. He frequents Mount Longonot, Gong Hills, Kilimambogo, and the Aberdare Ranges. George has held various senior roles in the industry, including serving CPF as the county head of South Sudan, Old Mutual as SME manager, Enwolf as GM, and Zamara as general manager. So at this point, ladies and gentlemen, allow me to welcome George Oyuga to the floor. Take it away.
Thank you very much, Stacey, for that elaborate introduction. And to our audience today and participants in this webinar, again, another warm welcome to all of you. Those who are joining us for the second time, this being the second webinar, I believe that the first one was value adding to your lives, and you got a chance to try and exercise or challenge the status of things on your end. Tracy, could I kindly request if I could share my screen? Can enable me to share my screen. The talk today is quite interesting. And one of the things that we like doing is to have some training aids. In this case, I have a few slides that I wanted to showcase as we begin. And it will be part of what will help us roll our conversation this evening. So is it okay now? Very good. So you will help me confirm if my slides are visible and also if they are on presentation mode.
Yes.
Okay, so are you seeing one screen or a split?
One screen.
One screen, excellent. Yeah, so this is webinar number 2 on the WISER series. And today we focus on saving, which is one of the modules in the WISER model that looks at a couple of things. Those who may be hearing this for the very first time, don't worry, because we'll not leave you floating. We will still be able to explain to you what the WISER acronym means. Now, remember what our moderator today, Madam Tracy, said, that we had a first webinar, which was the paycheck, black tax, and you. And there we were provoking you or challenging you to cultivate a desired balance between the many things. So today will be a continuation of the same. And those who are joining us for the first time, just allow me to introduce Kuza as well. We've heard who Pivot is. We are working together with them. Kuza means Kuza Asset Management Limited. The name Kuza was coined or came from the Swahili word that says Kuza, which means to nurture in Swahili. And for us, therefore, then we nurture our clients' financial journeys. So our website is kuza.africa. When you visit us there, you'll be able to see much and much of what we do. But in a nutshell, we were founded in October of 2021, and we are registered and regulated by Capital Markets Authority as well as Retirement Benefits Authority, because we do investments both for the public and also investments that are relative to the retirement benefits industry. So if you visit our website, you'll see on the investment solutions, we have the money market funds, we have the money market Kenya shilling and the USD, which is the dollar denominated one. We have Kuza Fixed Income Fund, we have Kuza Momentum Fund, and also what we call the Kuza Sharia Momentum Fund. So for us with this model of YZAR, one of the things that we believe, which the young people out there like saying, that there are people out there, if you talk to about life, how would you want your life to pan out? They'll end up give you in quotes what they call stories ajaba, you know? So what we are saying here is that if anybody was to paint a picture of wealth, and in this particular case, they give you a very, very good story. Even the Bible has stories about wealth and the like, where there is a man who leaves an inheritance for some servants there. We call it the parable of the talents. But in this particular case, we are saying that in as much as it is said that a wise man needs to leave an inheritance for his children, if that wealth that this person is trying to display to us does not have any investment traces, then definitely we'll be saying that whoever this person is, if these are not stories ajaba, meaning that whatever they're telling us is true, there's some wealth we can see, we can touch and the like, then this person definitely may be swimming in proceeds of corruption if we can't trace the investments part of it. Or this person may have been born in a very, very lucrative family. You know, those families where your name alone says everything up to your great-grandfather. That's sufficient. Then if that's not the case, then we'll be saying this person must be doing some WW, which we call the washes, you know, washing money here and there. Or again, if we can't tell exactly where the money is coming from, we may say this person is doing drugs. Or alternatively, this person must have joined some Illuminati sects or something like that, where there is money flowing. So what in a nutshell we are saying is that when wealth has an investment track around it, then you get respect and it gets respected. And for you to also discuss investments, then we are saying that, yes, this is what will preserve the growth of your wealth. This is what will preserve the accumulation of this wealth. But there can never be an investment conversation without savings. At the same time, you can't save what you've not earned. So again, because savings will give you the foundation of how and when to start investing, then at the end of the day, there is also no savings conversation without earnings. And then you cannot earn as well if you do not have certain relationships. For example, earning means that money is coming in, either because you are employed or because you are doing some business, meaning you have clients who are paying you. So if you're not selling a service, you're not selling some goods, and you're not employed somewhere, then it means that you will not have the earnings coming in. So earning will also need to be preceded by relationships. And relationships, therefore, is where all this conversation will start. So that means that anyone who follows the path where there was a relationship, and relationship can even mean that you will get all the way to wealth because you are just related to somebody, you know? either you got married to some rich guy, you know, so for you, you don't need to go through the earning, the saving, the investment. You jump straight from R all the way to W. And that's where I think the names of sponsors came by and the like. Yeah, whereby nowadays, when we're even talking about sponsorships, people are already smiling because it already has another meaning in the society. That's what not the path we are saying. We are talking about the path of a normal, hardworking you and me. We will start with the relationships where either you are an employee somewhere or you have some clients somewhere who are paying in and the like and the like. Now, there's a relationship with money so that to get to W is not you doing all the heavy lifting. It is your money doing all the heavy lifting. And that's what we are saying together with Pivot, that is where we want you to get to, where it is your money working for you. So that is what the WISE R model is, to say that W is wealth, I is investment, S is savings, E is earnings, and R is relationships. So in our first webinar, we dwelt so much on the relationship aspect of things, where we looked at how people relate with money and how also people need to understand what their behavior and the psychology of money looks like, and then get them to the earnings level where they'll challenge the sources of income, look for what else they can be able to do in terms of either tapping on their talents or increasing their earnings platforms or channels to actually get themselves to the S, which is savings. And so today we will be looking at savings as the third module in the WISE R model. So as we continue, then you will appreciate one of the things that because earnings are defined by relationships, there are many, many people who get to that level of earnings, but because they cannot or have not mastered how to tap into the next platform, which is the platform of savings, then they end up losing a lot simply because they do not know how to contain what it means to have growth in the next level. So in this particular case, then what we are saying is that we need to challenge people to say that yes, you may have been earning, but at the end of the day, because you cannot get yourself settled on the S, which is the savings, then there are certain things that you have either mastered, because as we normally say in life, choose your hard, you know, because it will always be hard. Life is hard, everything is hard. Working hand to mouth is very, very hard, you know. Working and trying to earn money on a weekly basis, week on week, is equally not easy. It's very hard. Working to earn on a monthly basis is equally hard. Working to earn in a quarterly basis or even half yearly, or working and getting only one paycheck every year is equally very, very hard. Now, spending as well is also not easy, because every employer who brings you on board expects that your spending will follow the X pattern that you see there in blue on the screen, meaning from the first all the way to the end of the month. In this case, I'm using up to the 28th, that you will have money loaded. You will not beg at any point. You will not reach a point where you have to fuliza. You will not reach a point whereby you have to call your Shylock or go into any of those apps and borrow, because the employer is expecting that what they pay you will spread you in the X way, you know? Yeah. From first all the way to 28, things will be smooth. But when the reality checks in, this is what we normally see. 16 days of blue, everything is sky, you know, nice, looking good. We are members of the sky team. Things are looking nice. Then the red checks in from the 17th, and then you discover that, by the way, when you look at your money and you look at the month, you have more month left than the money, because the money is finished. So you look at your survival mode. So how do you then survive from the 17th all the way to 28th? And maybe this has been your pattern. So in our first webinar, we were saying that there's a way we can choose not to feed the way Pythons feed, where you do one lump sum and then wait and digest until you get your next kill. No. Spread this tough days, these red days, into some portions of each of the weeks, so that you enjoy at least 4 days a week in pattern B, where you're saying day 1, day 2, day 3, day 4, things are good, but 5, 6, and 7, things are tight. But at least you live with the hope that by the 8th, then things are good again. So you pay yourself like every Monday or every Tuesday, depending on how you'd want your week to roll. So you spread the reds across the different weeks of the month, because now you know how much you have and how much you'll be able to spend. So, but we said that once you've done that and you've succeeded in making sure that this pain is spread across all the weeks of the month, then they do not form one big block, because surviving from 17th all the way to 28th is normally not the easiest, by the way. People go through a lot. Some of them, these are the times they become more stressed, because they cannot be able to see how they will get to the next earning, which will come in at the end of the month. Then once you've mastered how to do B, then you can graduate and go to C. And in C now you're saying, I am reducing the reds. You know, they were 3 in a week, now they're going to 2. Then they get to 1, and before you realize it, you'll have actually achieved what we are saying, the X model, which is smooth all the way, blue all the way from the first to the end of the month. But as I said, it's not easy. Leaving the X is not easy, leaving the A is not easy, leaving the B is not easy, leaving the C is not easy. Everything is hard, but you need to choose your hard, because monthly is hard, weekly is hard. You must choose your hard. Whichever hard you think you can work with, that will be it. But C is the lesser hard, because it moves you to D, where you reduce the reds from 2 to 1, and then from there you can actually get a fully blue month and things will be good. So people ask me, George, now that hard is hard and we need to choose our hard, in this particular instance, then when you talk about savings, these savings will come from where? So today, that is the main thing about what we want to discuss. And so let us allow the main thing to become the main thing and introduce ourselves to the savings conversation, which is normally module number 3 in our WISER model. So in the savings model, we're looking at, some people say it's the 4 wives, 1 husband model, where we are talking about the 4 W's and the 1 H. But that is promoting polygamy for some people, so I'll not go that way. I'll just say 4W, 1H, so that nobody says, yeah, okay, I have seen where polygamy works. No, the 4 W's are the why, the what, the where, the when. And then the 1H there, which some people say the 1 husband, is just the how. That will form what we are going to discuss today. So let's begin with the why of savings. Now, why of savings just simply reminds you that you are human. It reminds you that you are human because in the life stages that you have lived already or are in the process of living, you'll discover that you have 3 distinct stages. There is the infant stage where you are a baby. Everything else you had to depend on your parents to do for you, including anything that touches on financially. And that is now where we say, those guys who tell us that every new child comes with their own plate, they lie to us, because we have been told on and on again that it is good for us to be able to plan our lives, and that is family planning. So family planning will not be to say have 1 or 2 or 3 children only. It will be say have children in accordance to how your financial endowment looks. So whatever you are capable, if you can do 7, you have 7, because your resources can support the 7. If you can only support 2, then the same and the like. So that is what family planning would be. But some people have taken it to be 1 or 2 children. And so by the time you're calling them for the 3rd baby shower, they look at you like, with this economy, how? But as we say, the why of savings is just to appreciate the fact that life has different stages. So that child who comes in, of course, depends on you financially, you were a child, you depended on your parents financially. Then you got to a place where now it was not the infant stage, it was the dependency stage. So in that dependency stage, you are in school uniform, school pocket money and everything and all the like. But to some extent, you gave some slight relief even to your own parents or whoever was financing your education. Then you get to a point whereby now you have a job or you have a gig or you have a source of earning. So with this source of earning, therefore, that now you are in the independent stage. So when you get in the independent stage, there are certain things that you start dreaming about. And in this particular case, you have things like, oh, now I need to take care of my own medical. Oh, I need my college and advance my story, my path in life. I need to buy a house or build a house. We need vacation, we need retirement. And the list is there. It has needs and it has wants. But that, of course, would actually guide us on the why people would need to save. So there is the now, the life today. How do you want the quality of life to be? At times, the quality of life you have today is directly dependent on how you saved yesterday. Otherwise, if you didn't have savings yesterday, then today cannot be smooth. So if you also don't have savings that you are doing today, then definitely you are compromising the quality of life that you will have tomorrow. So tomorrow may be how you're trying to map it out in your life and in your mind as a future that is known. You know that, oh, I'll do this, I'll do that, I'll do that. But the truth of the matter is that you will always have another future that is called the unknown future. The unknown future is whereby things do not go the way you envisioned, things do not go the way you had planned them to go. So in this particular case, you may have planned this way, but things panned out this other way. You worked with all factors constant, thinking you will be in employment throughout, but things turn out that you are no longer in employment. You worked with an assumption that you will be healthy throughout. Things turn out that, by the way, maybe you have a terminal illness or an accident has happened, and you are even forced now to stop working and now get into what we call ill health retirement, because the unknown has happened, which you did not even project, you did not even imagine, you did not fathom, if I can use similar words, to try and show that at times it is not how you have planned it to be. So the challenge I want to give you today, ladies and gentlemen in the platform, is the 1% challenge. Take a piece of paper or a calculator or your phone and ask yourself, how much have I saved? So once you have the figure of how much you have saved, then divide or take 1% of that amount. So if you have saved 1 million, then 1% would be 10,000. For ease of mathematics. I know when things stop mathing, the math is not mathing. There are some people that find it a challenge to try and do a simple calculation on an evening, especially after a long day like today. So 1% of what you have. Now, that amount you're looking at, that amount you're staring at is most definitely how much you would afford to live on a monthly basis. If that unknown future was to strike today, I guarantee you that that is the amount of money you will have to squeeze your life into for a whole month. So if you thought, in the account I have 1 million, my friend, can you manage 10,000 shillings per month? Even those who save for the future and think they have saved a lot of money, definitely that is how much your annuity will be, that is how much your pension will be, that is how much your income will be if you don't borrow and if you don't rely on somebody else, including Serikali's idea. You know that famous phrase by Kenyans, Serikali's idea. So Serikali has no budget for that. So at the end of the day, the 1% of what you have saved so far will definitely need to sustain you all the way to the future if that is what you have saved. So I'm challenging you therefore then to listen to this conversation of savings, because if that 1% for you is sufficient, then you are among the lucky few. If that 1% is not sufficient, then this webinar is for you to consider savings and increasing or enhancing your savings to get to a place whereby your 1% can actually make sense for a whole month. So let's look at the what of savings. So in this particular case, there are people who will tell you, George, don't talk about money in the bank, don't talk about money in the money market fund, don't talk about money held is this way on this way. We have how we are saving. Some of you, maybe because of culture, for you, you are holding all these savings on other tangible assets, for example. So in this particular case, you're thinking that, oh, provided I have my assets there, because there are people out here, you may call them poor because they are not dressed in a suit. You may call them poor because they are walking in some akalas. You know what akala is? It's a special sandal that is prepared from the tire of a vehicle. It even comes with some threads so that you don't slip, yeah, on some grounds, yes? So it's a very special type of shoe. Does not even wear out easily. So you'll be saying that this guy who doesn't even have a shoe, yeah, does not look like he has any money, but this guy may be having actually like 1,000 heads of cattle. And if one cow alone would be going for around 40,000, then you can count how much this person is worth. But you will be clicking when they are passing with their wealth across the road. Yeah, the Maasais, we see some of them are even grazing in town, you know, provided anything is colored green, the cows will find it using their Google Maps, you know. Yeah, so you may be thinking these guys are not wealthy. They are wealthy, yes, but the liquidity of how they are saving their money is one thing, you know, and you're looking at a couple of things. So the other people also hold financial instruments. They buy bonds, they buy financial securities, they put money in their account, they have shares and all those, and for them, that is their form of saving. Others would just be collecting valuables. I saw the CEO of Private with some very nice portrait behind his back. Sir, where was that imported from? It may be one of his collections, very valuable collections, yes? So there are people who also collect artifacts, others collect valuables, others collect some things, even jewelry and the like, and they store their value in such. So fine, that is okay. But one of the things, or some of the things that one needs to look out for the mode of saving that they have adopted, include the aspect of inflation. You know, our great-great-grandfathers used to really value what we call cowrie shells. Today, if someone gave you cowrie shells for the job you've done, after a whole month, definitely you will go and report them to the nearest police station that they're joking with your blood and sweat, you know? How do you pay me using cowrie shells, you know? Others would collect other things, valuables and the like, others watches and all that. But inflation comes in, and inflation tells you that whereas somebody who was earning 10,000 shillings in Kenya in the year 1965 could afford to actually drive out with a brand new vehicle with that amount, 10 years, 20 years down the line, that amount reduces in terms of value, in that 10,000 that could buy a car in 1965 can now buy a motorcycle in 1985, can now buy a bicycle in the year 2000, can now buy a nice sports bike, you know, maybe in the year 2005 there. By the time we get to today, 10,000 shillings would buy a good sports shoe, is it? 20 years again down the road, your 10,000 bob will buy you a nice pair of socks. And you'll be wondering, all these things would of course be aiding your transport in one way or another, either by making your feet softer when you're walking or the like. But at the end of the day, inflation has eroded value in them. So where you are putting your money, where you're saving your money, you must make sure that inflation is on check, so that the value, purchasing power of what you are saving remains intact as time goes by. 5 bob when you were young would buy as a full loaf of bread. You can guess my age using that alone. Yeah. Today, I'm telling you, if you were to take somebody's even one slice and try to pay them 5 shillings, they would still call the police on you. Yet that was a whole loaf of bread for some of us when you were growing up. So all those are there. The other thing is security. Security also on how you're storing your value. If the guy who collects gold chains, for example, and you keep walking with them across the streets in Nairobi, one of these days you will lose your neck, you know? Yeah. Or somebody knows that you have gold bars in the house, definitely they'll come and break in, you know? So the security of that thing also becomes very, very key depending on how you're holding it. We know that there are areas or regions, even in our country, Kenya, where there is a lot of instability. Security has been threatened simply because people are hosting their savings in animals, for example. So in this particular case, we have cattle rustling, and that area we've sent even KDF there, and things are still not, there is no definite peace or defined peace, simply because the way guys are holding their savings, the form of way they are holding their wealth is attracting a lot of insecurity in the region, you know. The other thing you need to look at is the value appreciation. If that thing is appreciating in value, then definitely you must preserve that. The capital is growing in one way or another, you must preserve that, you know. So if you're saying that you've kept your savings in one form or the other, you must look at all that. How are you protecting capital? How are you protecting the value appreciation? How are you even risking your life, for example, in terms of security, you know, or inflation? The other thing that I've not mentioned there is liquidity. How fast can you transform what you have saved or the form that you're saving on to cash when you need it? Because I've seen people who have buildings, for example, but they lack the money to even attend to their medical needs, because you won't sell a house to go and see a dentist. No. At the end of the day, seeing a dentist requires money. And you will not say that my house is worth 30 million shillings and I need to see a dentist, so I'm going to sell this window pane. Some things can't happen, you know? You can't sell a portion of it. You either sell the whole of it to realize the value. If not, then it tells you that this form of saving and the need that I want to access it for are actually mismatched. And that is the reality of life. So the form of saving, meaning what are you adopting as your savings model, is therefore very, very important. Let me move on to the next W, which is the where do you save? So where do you save? We've seen that if you have your cattle, you're keeping them in some cattle shed somewhere, you are risking, because we may have maybe cattle rustlers checking it at night. You may have somebody breaking into your house and all those things. So the space where you save, therefore, then becomes very, very, very important to consider. And we say that saving in the right space is what you need to focus on. So if saving in the right space is actually what you need to look at, some people keep their money, for example, under the pillow. Others have drilled a hole in the mattress. Others have a piggy bank. Yeah, others are putting their money in a bank account. Others are putting their money in an insurance policy. Others are putting their money in a pooled fund, for example, the money market. Others are putting their money in a pension fund. But at the end of the day, you must ask yourself, in this place where I am saving, at the end of the day, how safe is this place? So if the space is something that we need to look at, then allow me to use the space as an acronym to then discuss a couple of things around how and where you are saving. So the first thing is safety. Safety can only be discussed if it is anchored on regulation. Meaning, if it is not anchored in law, if there is no law that protects that particular thing, then your safety is very volatile. So what do you look for? You look for whether where you are saving, the organization or the firm or the entity is regulated. So if your money is going in a bank account, then you can relax because your bank is regulated by the Central Bank of Kenya. That's the regulator for banks. If your money is going into, for example, a money market fund, then the provider of that money market fund needs to be regulated by the Capital Markets Authority. If your money is going into a pension fund, then that pension fund needs to be registered and regulated by the Retirement Benefits Authority. If your money is going into, for example, an insurance policy, which you're paying on a monthly basis, again, we are saying that that insurance company needs to be regulated by the Insurance Regulatory Authority. So the space where you are going, the safety then therefore becomes number one thing that you are looking for, and there is no safety if it is not anchored on regulation. Let's move on to the P, which is now protection. So protection here, related to safety, would actually be looking at where would you be if something went wrong, for example. So in this case, if you were saving in an insurance company with an insurance policy, then there is the Policyholders Protection Fund, which then should compensate you if things go south. If you are putting your money in the bank, then you're also asking yourself, if things go wrong and this bank goes under, would I be protected or would I be compensated? Yes, there is a Depositors Protection Fund. So currently in Kenya, I think it is at around 500,000 shillings. Meaning, if you kept your money, for example, even $1 billion in the account, and things happen and things go south, the most or the much you can get is actually 500,000 shillings as your compensation. If you're saving in any given space, we said safety first, then now protection is to say, what if? So if what if happens, then how much would you get back? That is what then need to look at when you're discussing protection. Number 3, A, access. We said your money or your savings are useless if they cannot help you when you need them. Meaning, wherever you're putting your money, access is another box that you must be able to tick. So if you put your money in a bank account, for example, then it means that when you knock or when you go there, you should be able to access your money. Now with banks, this is what happens. When they give you access, then the other thing they take away from you is in the E, which is the earnings, which we'll be looking at also as we continue. So access is very, very key, such that where you are saving, then, or the space where you are saving, A for access means that you need to save in a space where you can get your money when you want to access your money at any given time. C in our space acronym is cost, or the charges that come with you saving there. We said if your form of saving, for example, is cattle, then the security you need to put there, the way some of those guys actually even walk armed, young boys with guns. Why? Because they want to offer security to the cattle that they have. The cost of that, the cost of everything that you do to make sure that your money is safe, then becomes very, very key. Your bank account will levy some charges on your account maintenance fees, because of they have kept the money for you. So they need to charge you something. You need to pay for that. What is the cost of the space, or cost or the charges levied on the space where you are saving your money? You also need to look at that and look at that keenly. I know there's sometimes somebody ran an analysis of the costs of saving in our commercial banks and ranked the banks differently. So you'll discover that there are banks that were charging for account holders around 1,000 shillings, Other banks were charging around 800 bob, others were charging 700 bob, others were charging more than 1,000 shillings. So at the end of the day, because this is money that at times you do not even notice. Yeah, but the thing I normally tell people is that this is what, if you kept your money, 150,000 shillings, for a whole year in a bank account, and the bank that you have, you feel that they love you so much, and they are charging you around 700 bob per month as account maintenance fee, take that 700 shillings, multiply by 12, okay? And then from there, look at that as the cost that you are paying to maintain 150K in your account for that 1 year, and tell me what percentage that would be, you know? So when you look at the costs of all that, then it tells you that at the end of the day, you also need to be I would say, cognizant of the charges that you're paying to be able to have your money in that particular space. So 700 shillings times 12 is 8,400, is it? So 8,400 divided by 150,000. It means that you're paying around 5.6% as the cost of that. That is if your bank is charging you 700. If your bank is charging you 1,000 bob as the account maintenance fee or the cost of maintaining that account per month, then it means you need to do 12,000 shillings. Divide by 150. As a percentage, you get what? Tracy, what do you get?
12.5.
12.5%.
Yes.
Wow. So you have a cost. You have a cost of 12.5% just to maintain the account and keep your money in the bank. You're losing 12.5%. That's quite huge, is it? Yeah, and by the way, there are accounts. I know some of the guys logged into this webinar are heavyweights, high net worth people, who are paying around 2,000, almost 2,000 shillings as account maintenance fees or charges for that account you're holding premium with your bank. And look at how much that is. And my cue, I'm saying this person, where we are talking about this cost, has kept 150,000 shillings in the account for the whole year. Now, some of you may be saving less than that. So if you're saving less than that, then it means definitely your percentage is going higher, you know? Because if your savings are less than 150K for that 1 year, then it means that for you, then the cost is even higher. So there are people who are sitting with costs of almost 40%, costs of above 20%, simply because your savings are not at the threshold of what I'm talking about. But now at least I've given you food for thought so you can be able to consider. So as we look at our acronym again, there is the E, which is the earnings. So where you have saved your money, are you able to still get something to earn from it? Rather than just the cost, are you earning anything? So 1,000 USD kept in a USD account will be 1,000 USD at the end of the year. So 0 earnings there. Money held in the bank account, unless it is fixed. And remember, when it is fixed, you lose out on point 3, which is access. So at that particular point, then you have to forfeit access to be given earnings. That is what we call fixed deposits. So you forfeit your access to get earnings. So in that case, I think the best thing is get a space that can give you all the S, can help you tick the P, tick the A, tick the C, and tick the E. All the entire space is ticking the box for you. But if it's only one of them, then I beg to differ that, by the way, I think there's something that you can do better. So to challenge you today, I think let me conclude that bit by saying smart savings will guide you, because at the end of the day, smart people save in money market funds. So if you want a space that can tick the box for you, number 1 all the way to number 5, that would be a money market fund. And I'll be able to demonstrate that, but let me first of all start by defining what the money market fund is. So money market fund simply would be a platform that brings together many savers into a pool. And then, using the funds that have been raised in that pool, this pool is now able to access spaces that you could not have accessed as an individual. We are around 34 people signed up in this webinar, is it? So if each of us, the 34 people, had 10,000 shillings, yeah, then it means that with your 10,000 and my 10,000, if we walked to our bank and said, I have 10,000 bob, I want to deposit in my bank account with yourselves, how much interest, Mr. Branch Manager, will you give me? The branch manager will tell you, peleka jokes mbali. Is it? Exactly, that's the truth. They'll not listen to you. Even if you had 50,000 shillings each, there is no bank that would still be talking about giving you interest for 50,000 bob. It's not easy, unless they allow you to fix it in a fixed deposit account. So if we are 30 of us, or 34 of us, so 34 times 50,000, we would have pulled together 1.7 million. So the 1.7 million in the pool, now if we were to call one of those banks that any of us banks with and said, we have 1.7 million, and we discuss interest, that branch manager would be saying, yeah, I think we can start discussing interest now. So it means that if we had a vehicle that could actually bring us together, such that my 5,000 bob, your 10,000 bob, somebody's 20K, another person's 50,000, and the like, pulled together, then means that the pool once created can actually give us the bargaining power to be able to have interest loaded on our savings. And then later on, that platform distributes the interest back to us. So that my 5,000, if I was to go direct to the bank and say, I want interest on my 5,000, the bank will not listen to me. But if I have my 5,000 in a money market fund where it is pulled together such that, like for us, we push that and it gets to millions, hundreds of millions, like 200 million, 300 million. We approach a bank, the bank is willing to give us even 18% interest. Money that you cannot get, interest that you cannot get in a bank unless you are a very, very high net worth individual. So that is what the money market would help you do. So the money market is a vehicle that is licensed and regulated by Capital Markets Authority, and it is a low risk space because there are no risks on it per se. It helps you preserve your capital. It gives you a passive income, which you can create. It gives you high liquidity because this is money you can access within 48 hours. So even the access, the A there is not locked for you. The way it would be locked if you were to go into a deposit, a fixed deposit arrangement. So in this particular case, you'll be able to store your value as you wait for maybe invests later on. You'll be able to build what you call an emergency fund. And an emergency fund is very, very key because it helps you handle the unknown future that we talked about earlier. How much should be your emergency fund? It should be anything not less than 6 times your monthly expenditure. So if your monthly spend, Tracy, I know you are a high roller, is around 500K per month, yes? Then you need to have saved 500,000 times 6 to say that this is now my emergency fund, you know? So 6 times your monthly spend will be a very good, or the minimum emergency fund that you need to set up. But I normally say with this economy, I think targeting a 1-year emergency fund threshold would actually be better. So that for 12 good months, you know very, very well that if anything was to happen to you in the next 12 months, you will eat the same way you've been eating, pay rent the same way you've been paying. Your kids will go to school the same school. You know, they may be going to a group of schools. Some of us went to school in groups, so there's some differences there, you know, but there is nothing that will be disrupted for a whole 12 months as you regain your footing with time. 12 months is safe, but minimum 6 months. So the platform to do that is the money market fund, or that space. The other thing again is that you'll be taking advantage of economies of scale. We said you alone going to the bank with 5,000 shillings, you won't earn any interest. But you in a money market fund with 5,000 shillings, your 5,000 shillings will earn interest to the tune of almost 16%, as it is today with us in Kuza. You will improve the interest. At the same time, you will still have your money at least accessible within 48 hours, and you will not have tried growing your money by 16% in a space that is risky. For example, doing a business and the like. We all know that almost 40% of all the businesses that are set up, most of them don't see the 3rd anniversary. So don't wake up one day and feel like, Miki Kiumana, I'll become a business person. Where, as those people are on the ground, they will tell you the truth. At times, things are not as easy as people would think. So a money market fund would be good. If you are earning in Kenya shillings, there is a Kenya shilling money market fund. You can get that with us at Kuza through even Pivot. At the same time, there is a dollar-denominated money market fund, meaning that one deals with USDs. You can do, if you're earning in USDs, you can still do the same using that one. So that was the money market fund. So I want to compare those who save their monies in a bank account vis-a-vis those who save their money in a money market fund and tell you what the difference would be. And we will still use the same SPACE acronym to try and compare the two. So starting with S, where you're looking at the regulatory safety. Is the organization regulated and registered? Yes, the bank will be by CBK. And then is the organization regulated or registered? Yes, the entity will be like for Kuza, we are regulated by the Capital Markets Authority. Now, the product itself also, is it a regulated product? Yes, bank accounts are regulated by CBK. So you tick the box on that. When it comes to the money market fund, the unit trusts, because the money market fund is a form of a unit trust, is also regulated by CMA. And the regulation by there you get on an entity level from the money market fund is actually 3-tier, because money market fund will have a trustee, it will have a custodian, and it will have a fund manager. So the trustee in the Kuza case is regulated by both CMA and CBK. Why? Because the trustee is Coop Bank. From here, if you can see this clearly on the screen. So Cooperative Bank is the trustee for the money market fund with Kuza. The custodian is KCB Bank, and then the fund manager is Kuza Asset Management. So those 3 entities, each of them is regulated by both CMA and CBK for the banks, and then CMA for Kuza, as well as with RBA. So from a regulatory, the S ticks the box better for the money market fund than it ticks the box for your bank account. Then let's look at P, which is the protection, the level of compensation. If anything was to go wrong in your bank account, you will get a maximum of 500 shillings, 500,000 shillings back as compensation. But in a money market fund or a trust fund, you'll get 100% because the funds are held in a trust account. Governance structures for you in the bank is single entity, because if you bank with bank X, then it means that it is up to where the governance levels reach for that particular bank that you can say you are covered. But when it comes to the money market fund, it is 3 entities. Remember, we talked about the COP bank, in this case being the trustee, governance is there with them. Custodian being KCB, again, governance ticks the box. For Kuza as well, governance. So you have governance at 3 different organizations that are not related to each other, that all of them must satisfy the requirements of their regulators. So in that particular case, it is 3 entities regulation versus single entity governance. So that means the money market fund still wins again over the bank account. Then access to funds is the next point. How do they score? So if the access to funds, then you're saying that for you to be given any access for your money in the bank, if you wanted it to earn you something, you must forfeit access, either for 3 months, 6 months, or even 9 months, or even 1 year with the banks. But for you to have access, yet your money is earning you something in a money market fund, then definitely you have access within 48 hours anytime you lodge a complaint or not a withdrawal. Costs as well, the bank will charge you, and I think I already demonstrated this based on the charges you get in your bank account. For the money market fund, the returns you get are actually net of fees or net of the charges that are there. So by the time we tell you are earning 16%, fees has already been taken care of. Then the earning potential, you don't get interest unless you have so much money in a bank account, but you get interest from as little as 5,000 that you are saved in a money market fund. So money market fund in this particular case takes the vote for this comparison between saving in a money market fund and saving in a bank account. So remember what we talked about: safety, protection, access, costs, and earning. So you make sure you look at that when you're talking about where to save. I encourage you to consider a money market fund. It ticks most of all of those boxes better than a bank account. Now, when do you save? Is the next module, the next W. When do you save? Now, when to save could best be illustrated when we look at the money lessons from one animal we call the lion. The lion is not always positioned as the king of the jungle because of its size. No. If it was size, the elephant would be king. If it was height, the giraffe would be king. If it was speed, the cheetah would be king. If it was beauty, who would be king? I normally ask this question and some people tell me the peacock, others tell me the zebra, and I wonder, whoa, wow, you know? But every person is right, because beauty is in the eyes of the beholder. It depends on where you are focusing on the zebra, to say the zebra is the most beautiful animal on the planet, is it? So all those, you are right. But the lion is the king of the jungle because the lion is full of strategy. When you see the lion hunting, strategy. So the lion teaches us that you need to save fast before you start spending. The lion eats fast. When it has killed a prey, hyenas, vultures, all other animals of prey will, of course, be forced to wait on the side until the lion is full. So in this particular case, save fast before you start spending. And I want to ask you one question, because I know a majority of you here are Kenyans. What is the logo of KRA? The logo of KRA is the head of a lion. Meaning, when you have just finished earning like this, pay as you earn, KRA will be the first lion to eat before you even touch your money. That is why it is deducted at source. See, you guys pay tax before the money gets into your account. Or there's somebody here who has been trusted that they can actually take it and take it to Times Tower and go and say, I have come here to pay my tax. Never ever. Even the government does not trust you. You, the earner, the person who worked hard to get the money, you are not trusted. So the truth of the matter here is that, please, even for you, if KRA becomes the first lion in your financial jungle, then make sure you become the second lion. Roar next after KRA. Save first before you start spending. And the only way to do that is to try and automate your savings, meaning you will be at least putting a standing order, for example, to say when money lands into this account, it is swept all the way to saving to a certain percentage. Let it go there, so that by the time you start spending, you're spending, but your savings are already intact. It is the same model we use even for those who have joint pension schemes, because if you're an employee and you have a pension scheme with your employer, that money is deducted at source. It is the principle of the lion when it comes to saving. The lion eats first. When you want to at least succeed in the emergency fund we've talked about, where you need to at least put your savings target to a 6 months, at least monthly expenditure threshold, please consider using the lion's principle to automate and make sure that this thing happens. Put a standing order or allow a check or some check of system that sends the money to a bank account or to a savings platform whereby you are now accumulating your emergency fund. Don't do it in the bank account. I said the best space to do it will be in your money market fund. Pay as you earn has demonstrated to us that the lion that we all know is KRA. That lion eats fast. So be the second lion when it comes to that. And by the way, for you to succeed in this, make sure you have diversified your income channels the way we talked in our first webinar. That try as much as possible, hunt like a lion, don't hunt solo. Hunt in a pride, you know. Lions hunt in a pride. They walk in groups, in teams. And that way then your chances of succeeding are very, very high because you are a teamwork person. You have an accountability structure. And the best way to do that is if you have you and your few friends in this platform today, just make sure you form that as an accountability structure. Check on each other, whether have you started saving? Have you started putting money aside? Have you opened your money market account? You know, how much are you pushing every month? Have you achieved your target? Check on each other until you get there. If you don't have that person here, they may be somewhere because either they are your boyfriend, they are your husband, they are your wife. Please make sure you form that team with them and say, check me on this one. Be my accountability structure and let's try and see how we achieve this. So if it is about how do you save, then definitely you can score that by taking charge of your finances the way a lion would take charge of their space. So the how there in this particular case can only be possible also if you are able to draw a budget, work with a budget. And we have different budgeting models. Some of them will tell you that they adopt something we call a 50-30-20 rule, where you're saying 50% of my monthly earnings always go to my expenditure, 30% will be going to my savings, 20% will be going to my investments, or a part of the 30% will be going to pay my loans. Adopt what works for you. There are many, many models that you must look at. But when you are budgeting, the key thing to look at there is, do you know how to separate between your wants and your needs? Your needs are those things that you must do to be able to survive and live life. But wants are things that you may do when the finances allow or the like. Needs also can also fall in the category that they are must-dos and they are urgent. They need to be worked on urgently. At times, some things are not as urgent as much as they are needs, so you can sort them with time as time continues. Then the other thing again is that there are wants as well. So if something is a want and it is urgent, then also prioritize it. in one way or another, because the urgency there then builds on it. But if it is a want and it is not urgent even for later, like for example, I have a want that I one day want to tour which country in Europe, that one, yes, that is a want. It is something that you can push forward, you know, you can plan for it, save for it, but don't take a loan because you have to go. Don't take a loan because you have to do it. You have a want that you want to drive a car. You are tired of using your Subaru. Subaru is a vehicle that takes you to work when you're putting on your shoes. Yeah. Or there is the other one where you are talking about a Volkswagen. You know, a Volkswagen is the brand of vehicle from Germany where you walk to your destination. You know, related to that, there is another one that competes with it from Japan. It's called a Futsubishi. So Futsubishi is where you also get to your destination using your foot, you know. So all those are wants that you may want, but your need actually may be the need to move from one point to the other. So in that particular case, see how you prioritize all those things and get yourself there. But budgeting will help you tick the box on any of this. So money, Lion, do not forget those lessons. Save fast before you start spending. Automate your savings. Put a standing order if you can. Make sure you build on your emergency fund. Diversify your income channels. Then use a budget. A budget will help you be able to actually tick the box on that. So that was about our savings module today. And today, because we missed on this, the last one, where we didn't have participants asking questions, challenging a few things, challenging themselves as well. So today we'll create some time to be able to look at that. But before we do that, allow me to just showcase and say that at Kuza Asset Management, we have money market funds, and our money market fund has been performing very, very well. We are at the 75th percentile in terms of market performance. For those who track them, all these things are normally available even on print in the newspapers, and you can be able to see how our money market fund has been performing. We have that. We have the money market fund Kenya shillings, money market fund dollar, money market fund that would suit you. Then we also have fixed income fund as well. And then we also have the other funds that are there where you would need to be able to maybe set your goals based on the momentum fund or set your goals based on the Sharia momentum fund. For those who are of the Muslim faith, we also have something for you that at least helps you tick on your Sharia requirements. To join a money market fund, all you need is copy of your ID, copy of your PIN certificate with KRA, and a proof of bank, and then a minimum investment of just 5,000 shillings, and you're home and dry. Your 5,000 shillings in your bank account right now is not earning you anything. I am inviting you to push it to the money market fund with that at Kuza, and 16.14% for today's yield would have been yours. So up to there, Tracy, you can take it back and then help us with the next phase of this conversation. Thank you.
Thank you so much, George. That was a wonderful presentation. I personally have some questions, but let's start with some questions from the chat. Somebody is asking the minimum amount to open and said for the Kenya shillings, it's 5,000, right? We'll elaborate more on the US dollar account. And then Daniel Ongulo asks, on safety, please talk about Kuza market funds in regards to insurance by Kenya Deposit Insurance Corporation. And then some questions that I picked up from the previous webinar was particularly from students who are saying we do not have the 5,000 shillings to invest in Kuza money market funds. So what is there a provision for some of these young people who are asking, I want to save, but I don't know where, I don't know how, I don't know what to invest, because literally I have to take money out of my allowance. And then from me, when you said it's a pool, I wanted to ask, is this like an elite chama? So Those are some of the few questions. And then there's one from Mercy Kinyoa. She's asking, why does it take 48 hours to access my money? So a couple of questions there. If we have any questions from the from our audience, kindly do drop them on the chat, and Mr. George will be able to address them. Take it away.
Thank you very much, Tracy, and those are very, very good engagements. As we answer this, we hope that a few more would be popping up in our chat platform. So the question on what is the minimum amount to open a money market Kenya shilling fund, that one we have said is Kenya shillings 5,000. And I want to join that question with a question from the young people who say that we do not have 5,000 shillings. I would be telling you, I think you have the 5,000 shillings. It's just that you do not know that you have the 5,000 shillings. What is the value of your phone? How much do you spend on clad? How much do you spend on shoes? How much do you spend on going out every weekend? And all those things, you can still afford to open a money market fund, either from your savings, because I know 5,000 shillings is not a very, very high threshold to be able to achieve with your initial investment. Because the moment you've just opened it with 5,000 shillings, from there, then you can top it up with 1,000 anytime you have. And that means that there is that flexibility. So it is only the start point that may be a hurdle for you to try and raise 5,000 shillings to start. But once you have started, then it becomes a very, very easy thing. And remember, in life, no pain, no gain. So in this particular case, I know you have the 5,000 shillings. It's just that you do not know that you have or can access or can afford or can get 5,000 bob. So let us encourage you that indeed, if you really looked and drilled down properly, you discover that, by the way, this is money that you can get just within a whole month of either saving and forfeiting a few other expenditure areas or habits or engagements here and there. You can be able to get this. I know students, some of you are very, very rich because some of the things you are able to access, yes? Yeah, at times you see students and even the value of some of the drinks they have put on the table, and you look at yourself and you just feel like you hate your employer. You know, because your payslip cannot even get you closer there to some of the things that they use to actually cover the tables there. So anyway, what I'm saying is that 5,000 is not a lot of money. I am sure if you are very, very keen and you targeted this, you can be able to get yourself there. So if the money market fund or unit trust are a pool, are they some sort of an elite charmer? Wow, what a way of looking at it. Now, the question to you would be, does it feel like to belong to an elite charmer? Definitely, yes, it does. So there you go. If that is the answer, then fine. But this is one space that is, you know, charmers regularly are just social structured engagements. But at the end of the day, this is a regulated platform by Capital Markets Authority. The product as well is licensed by Capital Markets Authority to be able to help people to pool their small savings into a pool and still access the benefits that other people access because they have a lot of money. Today, if you walked into a bank, for the bank to give you 16% interest on your savings, you must at least have 50 million shillings as an individual and above. And some of them, even at that 50 million, you don't shake them, don't shake their brands because they've seen bigger monies. They would want you to have 100 million or so to be able to negotiate and get a 16% interest on your savings. Money market fund will give you 16% on as low as just your 5,000 bob. So that is what it means to belong to an elite charmer. Please send me the membership forms. That is what you should be saying, you know? Exactly. So I also need to elaborate a bit more on the USD money market fund. This one is dollar denominated, works the same way as the Kenya shilling one, but now dealing in dollars only. Meaning you invest in dollars, you save in dollars, we invest in dollars, we give you interest in dollars and all that. So the 5% you're seeing there is in dollar terms. Meaning, if you have to look back and calculate it backwards, then definitely it is also very, very high if you compare it in Kenya shillings terms. So how much do you need to open the USD money market fund? You only need 100 USD. That is just close to around 13,000 Kenya shillings, and you are in there, rolling with the people, touching the greenback. That's the dollar, is it? So there you go. Then someone also asked, why would it take 48 hours? Let me do this, to access my money. Accessing your money within 48 hours is simply because, number one, remember I gave you the tripartite arrangement where the fund manager is KUZA, the custodian is KCB, the trustee is Bank. So for any of these transactions to go through, it takes communication between all the three parties. So whether you are investing in the KUZA money market fund, KUZA will not make those decisions alone. So to give room for the engagement between fund manager, who is KUZA, custodian, who is KCB, and then the trustee, who is Bank, then that amount of time is needed. Because remember, that money, the moment you have it in there, for it to earn you the 16%, it is also invested in something. So it must, first of all, be disinvested from whatever space it is, if it was in the treasury bills, if it was in any maybe bank deposits and the like, back to cash for it then to be able to be paid to you. And that is why we do it in a record 48 hours. So Mercy, don't look at 48 hours like it's a lot of time. It's actually record time to have all these parties engaged to process your money and also give you an opportunity to be able to get your money when the money is needed within 48 hours. Part of it also is that within those 48 hours, we also take time to counter check. It may be somebody who took your phone, for example, because you had downloaded the KUZA app and all this money is there, they're trying to either fraud you or something like that. So all those things are meant to just help check that if Mercy wants to withdraw, are we sending this to Mercy's account? Is the account she gave us still active? And all those things and all those checks would take us the 48 hours, and you've had money with a lot of background activities going on there. Tracy, I think I've exhausted the first pool of questions that you had given me.
Yeah, I don't think you answered Daniel Ongolo's question on safety. He said to talk about KUZA money market funds in regards to insurance by Kenya Deposit Insurance Corporation. Let me add it to two more questions that we have received. From Khaled Koba. He asks, how and where are the funds pulled in KUZA money market fund invested? Is there a minimum guaranteed investment rate? And then Mercy again asks, how frequent does one need to invest towards the money market fund to see substantial interest? Is it monthly, weekly, or daily? And what will be the preferred minimum rate? Maybe just also to add on to her question, could you paint a picture of what saving in a money market fund would look like? If I invest my 5,000 shillings, what would it look like for me as I continue to save in the money market fund? Thank you.
Okay, thank you very, very much. Now, in my forms of saving, and Daniel, I'm sorry, I may have skipped your question. In my forms, conversations around the forms of saving, we talked about the different forms that people need to adopt. And there are many, many financial vehicles that one can adopt within our market here in Kenya. So when we have our savings in the insurance space, the regulator in that particular space would be the Insurance Regulatory Authority. If I have my money in a SACCO, then I would have SASRA, is it? If I have my money in a bank account, then I would have Central Bank of Kenya. If I have my money in a money market fund, then I would have Capital Markets Authority. So all these different spaces would take care of your money depending on the platform that you took or the financial security that you have adopted. So when it comes to the jurisdiction of the likes of KDIC, then definitely it will be talking about savings in banks. And then if you have the compensation fund for insurance, it will be talking about those who are also doing their savings in an insurance instrument like an insurance policy and the like. So when it comes to the money market fund, then what we have is the Capital Markets Authority, and the Capital Markets Authority also previously did not have a deposit or an investor's compensation arrangement, but right now there is one that has already been set in place. So in that particular case, then it ticks the box when it comes to safety. Then the other thing, again, we talked about in the safety is safety in terms of the organization being regulated. KUZA is regulated and registered by Capital Markets Authority and Retirement Benefits Authority. Then when you have to safety of the space where you are coming in, unit trusts in this country are regulated and they have to be registered by Capital Markets Authority. So that gives you that safety. Tick the box on safety from a regulatory point of view on the organization, and also safety from the regulatory view on the product itself, meaning the money market fund. There is one particular provider in this market who messed things up, because whereas they were regulated as an entity, they ended up putting people's monies in a space that was not regulated, meaning the product itself was not regulated, and people ended up losing money or having a clog in that they could not get their money back when they needed their money. I do not need to mention them by name, but by just saying so, I am sure there are a number of you who by now already know whom I am talking about. Now that is on safety. Then is there a minimum guarantee that you have in this space? So the guarantee here is provided for by the structure of the money market fund, in that the money market fund promises you 100% guarantee on your capital, meaning that whatever amount of money you put in there, there is that 100% protection on your capital. Because even fees and all those things that are charged, they are charged on the interest or on the earning that your money has done. Like now, when we say we are giving you 16.14% as at yesterday, then it means that we actually have already taken away the management fees from that, and what we are giving you here, 16.14, is net of fees. That is a requirement by regulation, meaning that anybody who is giving you a money market product in this market must, first of all, adhere to all those structures such that your capital is protected. So that would give you the guarantee that you have, or that you need when it comes to that particular case. Then somebody asked about the frequency of saving. How frequent should you save? Is it monthly? Is it weekly? Is it daily? And the like. The money market space is an open space. You save according to your ability. So if you are able to push money there on a daily basis, because maybe you run a car wash, you are a salonist, you know you earn on a daily basis, and you want to save before you go home, you are free to do so. And it is as easy as just generating a push button from your fund. If you have downloaded the app, and that means that you'll be able to do that from your M-Pesa. Another person will be earning on a weekly basis, wants to save weekly, you are free to do so. Monthly, you are free to do so. And by the way, money market does not penalize you in any given time if you fail to do or to deposit the way you had wished. You may do the 5,000 today, tomorrow you don't have. You have it again next week. Well, as and when you will have, that is when you will invest. So there is no penalty per se in any given period. If you said you want to do it monthly, you want to do it weekly, you want to do it daily, and then you fail, there is no penalty in that particular aspect. Then, Tracy, you asked me to paint a picture of how and what it feels like to invest in a money market fund. This is what it means. When I invest in a money market fund, and I hope I'll be a good artist to paint this picture, yeah? When I invest in a money market fund, this is what happens. I open the account. Once I have opened the account and uploaded the 3 documents I talked about, which is a copy of my ID, a copy of PIN, and a proof of bank, which may just be the front side only of my ATM, or a caption of a piece of my statement to just show this is the bank, this is the account number, and this is the account holder's name. Just that is what all is that is needed. Then you open the account. Then once you've opened the account with, for example, Kuza, and you pushed in your 5,000 shillings as the first amount. I'm not saying you limit it to 5,000. If you can do 500,000, well and good for you. However much you can, please invest as much as you can, but minimum 5,000. So these 5,000 shillings into my account with Kuza today means that tomorrow morning, my 5,000 starts earning at the rate prevailing for that day. So by the end of the day tomorrow, my 5,000, which was present, will be present by tomorrow morning, will have earned at the rate of 16.14% annual yield for that particular day. So the system will calculate how much I have for that day and book that balance somewhere. So that would mean 16% of the money I have, which is annual rate, and for that one day times 1/365, is it? To get the daily rate. True? So that means that day the system books in that amount. Then on day 2, the system books in that amount, whatever I have. Like that. At the end of the month, all these amounts that have been booked in by the system now get calculated, summed up, and they are topped up on my account to form part of my opening balance for next month. That is called compounding. Compounding works magic because it means that even the interest that I have earned for this month, when it is now credited to my Kuza account, then it will simply show that my opening balance for next month, which is the month of June, will be slightly higher than the 5,000 shillings that I put today, you know? So all the monies that you put and the interest is calculated on the balance in your account for that particular day. So if today I have done 5,000, tomorrow again, because maybe I run a business or a gig somewhere and I have another 5,000 which I've pushed to my money market account now has 10,000, is it? So for day 1, I had 5,000. So that interest times what I had, interest of the 5,000. Day 2, I have yesterday's 5,000 and today's 5,000. So the system calculates interest for my 10,000. Day 3, because maybe I've pushed in another 10K, now the system calculates interest for total amount in my account that day. That interest is booked. Then at the end of the month, all those interests, the interest I earned on day 1 when I was starting to day 2 to day 3, like that, depending on the balance that was present on that day, all of that is summed up and then it is now paid into that account for me to form part of my opening balance next month. So next month will be total deposits plus interest for last month's deposit in there. That becomes my opening balance. And from there, that opening balance is what now will be used to calculate interest going forward as we continue. Isn't that beautiful? Because my savings plus my interest at some point are also participating in interest again. So it is interest over interest when you are looking at it downstream. And that is what we call compounding, and compounding works magic, because the total amount of money you will see you have by the end of the period, or 1 year or so, will actually be so much you could not have gotten if you are investing in another place that only applies what we call simple interest. Back to you, Tracy.
Well, that was quite elaborate, George. Thank you for painting the picture. But I hope we've all learned something. We're slowly coming to the end of our webinar today. Thank you for your patience and for giving us this extra 19